public session. Item number 1, the minutes of the meeting 28th of February 2013. Are the minutes agreed? Agreed. Item number 2, matters arising from the minutes. There's only one matter arising from the minutes, and that's to engage a rapporteur to assist the committee in drafting the report, which we discussed at the last meeting and at our private session. The clerk has done some work on this, so is that agreed? Correspondence since our meeting Thursday 28th.
Sorry, Chairman, just on that, as we say agreed, where does it stand? Have we appointed somebody? Or you
no, I have to.
You could have got to tender, is it?
Yes, we'll have to go to tender for that.
Okay.
Yeah. Yes, the bank
stabilisation.
Few words on it, Chair.
Yes.
Can you just outline what the process will be? I know we've covered it, just to refresh my own memory. What's the process that we're going through now?
We agreed at a private session then at our last meeting that we would do this piece of work, which essentially is picking up from the work of the last Public Accounts Committee.
Taking the interim report. I don't think they ever find there was no interim report.
No.
Fine.
So taking all of the body of work that they did and all of the documentation that they received from the Department of Finance, and then linking it to a current report from the CNAG, and in other words bringing it from that date right up to date, and put the accompanying documents with it, and that the rapporteur would look at all of those documents, because there is a lever arch file of documents that need to be examined. And we could ask today perhaps if some of those documents that are redacted might be given
rapporteur as a consultant, is this? Who will be acting? Who will the rapporteur be?
Oh, a consultant.
Consultant.
Yes, we haven't.
And will that go to tender, or we just appoint him?
No, we'll have to go to tender.
How long will that take?
Just a couple of weeks, basically, like maybe about a 5 months.
And they'll compile what's there.
Yes.
Come back to us, and we then decide in terms of witnesses or whatever is required.
Well, I suppose it'll be based on the evidence that we've taken up to and including the evidence of today. And it'll be a piece of work that I suppose will record all the work of the PAC.
I'm asking here, will there be any further hearings here in respect to this report?
Yes, the answer to that is that we're bringing full circle the bank stabilisation matter today, and today's hearing will factor into the work of that. Then after that, when the report is being drafted, we can then decide on what further work or further witnesses need to be invited. And we can do that as we
set a time frame on completing this body of work.
Within the next few weeks, we'll have the rapporteur appointed. And it's hard to say how long it will take, but it's only a matter of weeks, I would imagine. Because the work is already done and the paperwork is there.
But in terms of launching this report, are we talking...
after Easter. We're talking after Easter to launch any report, to actually launch a report.
So what we're looking at really a draft report probably sometime early after Easter.
Yes.
And then we take it from there.
Yeah.
Yes, that's right.
And we don't want to hold ourselves to that, because it's fair to work at it.
No, I'm just saying, Chairman, but the first cut-off line is the report back from the rapporteur.
Yeah.
Which one would expect sometime middle April.
Middle April, because we'll be back then.
And then we can decide on the witnesses if
fine.
Okay.
Thank you.
Correspondence then received since our meeting on Thursday 28th of February 2013. 3A's correspondence from accounting officers and our ministers. 3A1 correspondence received 1st of March, Mr. Fred Barry, Chief Executive National Roads Authority, providing information requested at our meeting the 7th of February 2013. That to be noted and published. Just wondered, that letter, does that cover the information requested by Deputy Dowds in relation to the tolls and that? We just check that, because
I'll check that and come
there was information outstanding from the NRA and it hadn't come in. I'm just wondering, is it contained in that letter? If we check that, we'll come back to it. 3B, individual correspondence. Correspondence dated the 4th of March 2013 from Mr. Cahill Guimar, Commissioner for Aviation Regulation, forwarding correspondence with the Department of Transport, Tourism and Sport regarding the Commission for Aviation Regulation pension scheme. To be noted. Documents relating to committee meeting 7th of March 2013. 3C1 correspondence dated 4th of March from John Morton, Secretary General Department of Finance. Briefing papers for today's meeting to be noted and published. Correspondence dated 5th of March 2013 from John Morton, Secretary General Department of Finance. His opening statement to be noted and published. Reports, statements and accounts since our meeting 28th of February 2013. 4.1 County Kildare VEC annual financial statements for the year December 2011. 4.2 National Roads Authority annual financial statements for 31st of December 2011. Work programme. The programme is now on the screen. Speakers have been scheduled up to the 2nd of May 2013, and if there's any difficulty you have with that, you can contact the clerk. 6 report on Irish Aid. A draft of this report has now been circulated, and I would ask members to contact the clerk if they have any views. We'll sign off on this report next Thursday, and I propose to launch the report then and the report on the HSE, which was completed a few weeks ago, on Thursday the 14th of March after PAC about 3 o'clock. Any other business then?
Chairman,
Harris.
Chairman, there's been a number of media articles recently, and I've also been contacted by a number of people in the greyhound industry in relation to the operation of Board na Gán. And I'm sure that Board na Gán, as much as those also involved in the industry, would welcome an opportunity to address these issues. And I would just wonder, with that in mind, would the committee consider writing to the accounting officer, under which remit Board na Gán falls to just seek a response to the issues that are in the public domain of this situation in relation to the operation of the board, that I think would be helpful for the industry at large if they could be cleared up.
Yeah, well, we've also had some correspondence in the past, I think, in relation to issues. We might just pull them all together and write.
Yeah, I think so. I mean, there are relatively new issues that have appeared in the national media in recent weeks that I think it would be useful if there could be responses. So.
Okay.
Yeah, we can certainly do that.
That's okay, Deputy. Can we agree then on the agenda for Thursday the 14th of March at 10 o'clock? We'll meet with the Department of Social Protection. The agenda for the meeting will consist of 2011 annual report of the CNAG and appropriation accounts, 438 social protection, Chapter 21 expenditure on welfare and employment schemes, Chapter 22 welfare overpayment debts, Chapter 23 regulation of social welfare payments, social insurance funds, annual accounts 2011. That agreed? Okay. Now ask the witnesses to attend. Item number 8 then, 2011 appropriation accounts and annual report of the CNAG. Vote 6, Office of the Minister for Finance. Chapter 1 financial outturn for 2011, Chapter 2 government debt, Chapter 3 banking and insurance measures, Chapter 5 EU financial transactions. Before we begin our meeting, can I remind members, witnesses and those in the public gallery to turn off your mobile phones, because the interference from the mobile phones affects the sound quality and transmission of the meeting. I want to advise witnesses that you are protected by absolute privilege in respect of the evidence you are to give this committee. If you are directed by the committee to cease giving evidence in relation to a particular matter, and you continue to do so, you are entitled thereafter only to a qualified privilege in respect of your evidence. You are directed that only evidence connected with the subject matter of these proceedings is to be given, and you are asked to respect the parliamentary practice to the effect that where possible you should not criticise nor make charges against a member of either House, a person outside the House nor an official, by name or in such a way as to make him or her identifiable. Members are reminded of provision within Standing Order 163 that a committee should also refrain from inquiring into the merits of a policy or policies of the government or a minister of the government or the merits of the objectives of such policy. I want to welcome Mr. John Moore, Secretary General of the Department of Finance, and can I ask you to introduce your officials, please?
Let me first say thank you very much, Chairman, and my officials today are Sep Carty, who's an Assistant Principal in our Finance Office, Anne Nolan, who's Second Secretary in the Financial Services Division, Jim O'Brien, who's Second Secretary in the EU and International Division, and that you have Derek Moran, who's an Assistant Secretary in the Fiscal Division, and Garrett O'Neill, who's our Chief Financial Officer.
Department of Public Expenditure Reform.
My name is Dermot Quigley from the Department of Public Expenditure and Reform.
Can I ask the Comptroller General to introduce the accounts, please?
Thank you, Chairman. The annual finance accounts present an account of the payments into and out of the central fund of the Exchequer, together with a set of statements that analyse the transactions. The financial statements of the national debt, prepared by the National Treasury Management Agency, are presented in full as Part 2 of the finance accounts. The chapters that are the subject of today's meetings were compiled to highlight key aggregates and trends in central fund transactions and broader state liabilities, as well as overall financial transactions between Ireland and the European Union. Chapter 1 summarises the Exchequer's financial outturn for 2011, when central fund issues exceeded receipts by €25 billion. About €11 billion of the deficit was due to payments made in 2011 in respect of bank capitalisation and promissory note payments. Chapter 2 sets out trends in the general government debt since 2007, when it stood at around €47 billion. The debt has risen sharply since then, reaching €169 billion by the end of 2011. Official general government debt figures for 2012 are not yet available from the Central Statistics Office, but the Department of Finance, as part of its projections for Budget 2013, estimated that it would be around €192 billion, or 118% of GDP at the end of December 2012. General government debt at end 2011 included the promissory notes issued by the Minister for Finance to IBRC and the Educational Building Society as part of the process of bank recapitalisation. These were not included in the NTMA's financial statements of the national debt and are disclosed only in a footnote on page 24 of the 2011 finance accounts. IBRC had used the promissory notes it received as collateral for borrowing from the central bank. When the special liquidator was appointed to IBRC last month, the central bank became the owner of the outstanding promissory notes to the value of €25 billion. Government bonds with a floating interest rate and an average maturity of 35 years were issued to discharge the liability under the promissory notes, thus adding €25 billion to the national debt. Because this was an effective reclassification, the overall general government debt balance was not affected by the refinancing. The general government debt was the main liability of the state at the end of 2011, but there were other significant state liabilities that are not accounted for in the finance accounts. There are very substantial state liabilities arising from the future pension entitlements of public servants relating to their past employment, but no estimate was made of that liability at end December 2011. The last available estimate, presented in a previous Auditor General report, was an amount of €116 billion as at the end of 2009. Since that estimate was made, there have been significant changes in public service pay and pension entitlements. In addition, there may need to be revisions in the key assumptions underpinning the estimate, particularly in regard to projected future salary increases and the rate used to discount future estimated payments. These could have a significant impact on the estimate of the liability. I have recommended that actuarial reviews should be carried out at regular intervals to ensure that the state is aware of the long-term cost impact of public service pensions and the timing of outflows. Future commitments under public-private partnership contracts in place at the end of 2011 were estimated at €4 billion. The cost implications of these contractual commitments have been dealt with by the committee on a number of occasions. In my view, those financial commitments should formally be recognised in the finance accounts. The purpose of Chapter 3 is to provide a further update on the costs to the state of the range of banking and insurance measures implemented in relation to the ongoing crisis in the financial sector. The measures taken affect a number of sets of financial statements and do not all impact on the central fund of the Exchequer. As a result, their full financial impacts can be difficult to ascertain. While the chapter contains information up to around mid-2012, the financial position is evolving. The accounting officer will be able to give a more up-to-date position on the cost of the bank guarantee, liquidity support for banks, recapitalisation and other restructuring measures. By mid-2012, the state had made an investment of just over €65 billion in 3 financial institutions in which it had acquired full or almost full ownership. That's Allied Irish Bank, Permanent TSB and the IBRC, and in Bank of Ireland in which it has a minority interest. The adequacy of the funding injected by the state to meet the capital requirements of the banks that are still trading depends on the net losses they incur in the period 2011 to 2013, not exceeding those projected by the central bank. While no time frame has been set for the state's withdrawal from its ownership of the banks, there is a prospect that the state may, in time, recover some of its capital investment. The state's residual value in IBRC, if any, will depend on the amounts realised from the disposal of IBRC's assets. Ultimately, the objectives of the banking stabilisation measures are to return banks to sustainable levels of profitability and to ensure that normal access to credit is restored for business, especially small and medium enterprises. Chapter 3 reports that AIB and Bank of Ireland have been meeting the lending targets set as a requirement of their recapitalisation by the state. At the same time, reviews of credit availability for small and medium enterprises suggest that normal access to credit has not been restored. In that light, the usefulness of setting performance targets for the banks in terms of gross lending to SMEs may be limited. The Insurance Compensation Fund, which operates under the control of the President of the High Court, was set up to meet liabilities of insolvent insurers. A significant additional funding requirement for the Exchequer arises from the administration of Quinn Insurance Limited, which has a requirement for funding currently projected at up to €1.65 billion. Related payments out of the central fund commenced in late 2011. Up to the end of June 2012, the Minister for Finance had advanced a total of just under €730 million to the Insurance Compensation Fund to allow it to meet its obligations in relation to QIL. Receipts from a levy on insurance sales will ultimately be available to repay the Exchequer, but substantial additional advances from the central fund are likely to be required in the short to medium term. Chapter 5 was compiled to bring together information on financial transactions between Ireland and the EU. The finance accounts reflect most of the payments to the EU, but substantial receipts from the EU do not pass through the Exchequer. In 2011, Ireland continued to be a net beneficiary of EU funding, with contributions of €1.4 billion and receipts totalling €1.9 billion. Direct payments of €1.3 billion under the European Agriculture Guarantee Fund accounted for around 2/3 of the EU receipts. In conclusion, Chairman, the finance accounts are primarily a cash-based record of receipts and issues from the central fund and of borrowing undertaken by the NTMA on behalf of the state. Certain supplementary information is provided in relation to state shareholdings in commercial bodies, Exchequer loan transactions and guarantees. While the finance accounts comply with the form specified by the Minister for Finance, there is scope for a more complete and transparent account of the financial transactions of central government and of the state's financial position at year-end. I recommended in my report that the Department should review the level and quality of disclosure in the finance accounts so as to increase the transparency of public financial information. I understand that the Department is making a number of changes for the 2012 accounts. In addition, a broad-ranging review of Irish fiscal reporting is underway. The accounting officer will be able to provide details about those developments. Thank you, Chairman.
Thank you very much. Can I call on Mr. Moran for an opening statement, please?
Okay, again, thank you very much to Chairman and Committee. I guess yesterday was the first anniversary of my appointment as Secretary General, and it was certainly a busier year, but I suppose I had expected that. I think people are aware of it, but one of the early initiatives that we had was to revise our statement of strategy. that we inherited when the new management team took over. And it was basically to place a much greater focus on our objectives, which was economic stability, growth and jobs creation. And we therefore set out 5 goals that we would sort of group all of our work around. The first was with respect to the economy. The second, sound public finances. Third was improved living standards for all citizens, a return to market funding, and finally a more secure and effective banking system. We also then conducted a review and set out ways in which we were going to change the way in which we were operating as a department. Looking back on 2012, and I suppose starting with the economy, we know that economic growth and a recovery in employment are crucial preconditions for a sustained improvement in living conditions. And we still see a situation where domestic demand is constrained as households and firms work off the imbalances that have built up during the boom. And so our job is far from complete. The unemployment rate remains at unacceptably high levels at 14.1% in February, and household debt to income ratio, although falling to its lowest level since early 2007, still is at a very high rate of 204%. So, not surprisingly, our 2013 programme reflects our continued focus on the steps necessary to work through those problems, and in addition to that, to focus particularly on ways to facilitate a recovery in the SME sector, which we see as a key sector to get real reductions in the unemployment rate. The challenges are, however, very significant. But in facing these challenges, we think it's important to remember just how different Ireland is at the moment from an economic perspective than even only 12 months ago. We've now completed over 190 of our programme tasks, and we've drawn down about 83% of the funding under the Troika programme. We're working, therefore, towards being the first euro area country to exit from a programme of financial support. Anglo, IMBS, the promissory notes, the bank guarantee are now all historical parts of a banking sector rescue. We have sold Irish Life back into private hands and traded 1 billion of the contingent capital we put into Bank of Ireland, both at profit to the state. Central bank support, which was a key part of the restoration of stability for our government bank-supported banking sector, is now down a further 28% year on year and stands at only 48.1 billion in January of 2013. Following a return to growth in 2011, the Irish economy looks to have recorded a second successive year of growth at 0.9%, contrasting to a contraction across the euro area of 0.5%. The Composite Purchasing Managers Index remains in expansionary territory and puts us, in effect, only with Germany in a club which is actually showing growth in that area. The recent Commission forecasts estimate that unit labour costs are forecast to have improved by 23% relative to the euro area over a period from 2008 into 2014, which underlies the flexibility of the Irish workforce. Having increased in Q3 for the first time since early 2008, the fall in domestic demand is showing signs of having bottomed out, and core retail sales have increased in each of the last 6 months, with VAT receipts positive in the first 2 months of the year. The level of exports is now well above the pre-crisis period, having increased by 3.2% over the first 3 quarters of 2012, and stands at a very significant 106% of GDP. And in the context of exports, the services export sector is particularly strong, having grown by 9.4% over the first 3 quarters of 2012 also. The current balance of payments has shown surpluses of over 3 billion in each of the last 2 recorded quarters, and 2012 taxes on a headline basis were up 7.7% year on year. All of this has contributed to a further reduction of the deficit, and we expect a deficit of less than 8% for 2012, which is again significantly below the Troika target of 8.6% for the year. Now, I understand, of course, that these fiscal adjustments are in many cases painful, but they are, however, essential to the restoration of growth in the economy, to our ability to go it alone after the end of the programme in December, and to the restoration of international confidence in the economy, which will be reflected in further investment and jobs. It couldn't, however, be passed upon that we are a very open economy. I've mentioned the size of our GDP and our exports, and we are therefore very dependent on a continued recovery in the performance of other large trading blocs of Ireland. In the last 12 months, however, we have seen very strong external validation of the strategy we are following. The IDA has had a record year in 2012, and most encouragingly, stabilisation of the labour market has finally emerged. Ireland is back in the markets, issuing conventional bonds of 4.2 billion, 1 billion of amortising bonds, short-term treasury bonds of 1 billion, and bond switches of 4.5. There has been a dramatic increase in interest rate costs for the country as confidence in Ireland has improved over 12 months. We've seen T-bill costs drop dramatically to a range of 20 to 25 basis points compared to the first issuance in August 2012 at 1.8%, and our 2- and 8-year spreads are now in the region of 1% and 3.7%. And I suppose it's worth recalling that only 20 months ago, these two numbers were at 22.4% and at 15%. It's worth noting, in terms of the importance of this, that with a stock of debt approaching 200 billion, even a 1% movement or reduction in interest rate costs can very dramatically improve the interest costs of our budgetary numbers. We are seeing also in the last 12 months growing levels of investment in many sectors of the economy, particularly from outside, including commercial property. And all told, 10 billion has been invested or committed in the past 6 months, mainly by international investors in transactions managed by the state or entities controlled by the state. I mentioned at the beginning, in terms of our statement of strategy, that we set out over the last 12 months to play our part in all of the events above, but in parallel to embark on a very significant change agenda in the operation of the department. More detail is contained in our review of 2012, which we'll be publishing later today. In brief, though, we have implemented a complete restructuring of the department into 4 key policy areas and 2 support offices areas, a finance area and a corporate office. We have restructured the operation of our Management Advisory Committee, which now focuses more on business planning and objective delivery and on challenge sessions on key policy areas. We have an enhanced risk and control environment, which has included the creation of a Chief Risk Officer position, which reports directly to me, and the implementation of a risk committee, and a radically different approach to audit committee and internal audit support. Along the way, we have also tried to extract significant cost savings of almost $750,000 through the reorganisation of accommodation, which has resulted in reduced premises footprints, and through other initiatives from our support from our colleagues in Tullamore, which is a shared services office, who have been embarking on various reform measures such as the elimination of payable orders and the reduction in the frequency of issuing pay slips. Indeed, overall in 2012, we delivered our programme with approximately 7 million savings against budget, which has included, of course, certain deferral of costs where possible. One of the other hallmarks of 2012, in terms of the change of the way the department has operated, has been a much greater openness. We've had much more frequent public speaking and media engagements, greater interaction with the wider public sector and the private sector, as well as the secondment of a number of specialised resources into the department to assist with various tasks before us. We've also deepened our links with other government departments and state agencies in 2012 and have therefore availed of resources from a number of these. We are certainly in a position where we are proud of our achievements, but as we noted earlier, there is still an awful lot to do, and we remain committed to that task. I have noticed, especially of late, a welcome growing appreciation of the effectiveness of the public sector and its contribution to the higher profile deliveries I've outlined above. I would like to put on record my gratitude to the staff of the department for their continuing help and support, and I would particularly like to record the efforts of the unsung heroes who behind the scenes somehow make it all possible. Whether it is in managing the legislative process, answering your own parliamentary questions, dealing with the scheduling of stakeholder visits, implementing foreign trips, preparing strategic briefings, ensuring the preparation of financial accounts for payments across the system, printing materials often at the last minute and late into the night, or just keeping the offices and the IT systems open and working well. All of those and other things are essential to the functioning of the department and the delivery of the objectives we have set ourselves. In this difficult time for all citizens, I think it's only fair that I also recognise publicly their contribution and willingness to be flexible and adaptable in dealing with the many conflicting time demands on our department. I look forward to your questions, and thank you again for your attention.
Thank you, Mr. Moran. Can we publish your statement? Deputy Simon Harris.
Thank you, Chairman, and Mr. Moore, and you're very welcome and your team here this morning to the Public Accounts Committee. And I want to begin by echoing your words of thanks to what you aptly describe as the many unsung heroes in your department. I think we all got some insight during the passage of legislation here recently and during various efforts at a European level of the level of work that has been undertaken, obviously at a political level, but also at an official level within your department. And those to the fore in political life tend to get credit for these things, and it's important also to acknowledge the role played by a number of your staff. And I think the Taoiseach did that in the Dáil in recent weeks, and I'd just like to echo it here today. I'd just like to, and also a happy anniversary, I suppose, to you in relation to your first year at the job. You've certainly had a very busy year, and I think that is evident from your opening statement. I just want to hone down into some details of issues that have arisen from the CNAG's reports, also from your own statement of strategy, and just from other issues relating to your department that are issues of public discourse at the moment. And I'll structure my questioning around 6 areas. Firstly, the European situation in relation to our own debt. Secondly, your banking division within the Department of Finance. Thirdly, the issue of bankers' pay and the ongoing Mercer's report. Fourthly, the review of, your new revised statement of strategy, which you referred to in your opening statement. Fifthly, the issue of IBRC. And then finally, the issue of the ending of the bank guarantee scheme at the end of this month. Just to start with and I'll just do a back and forth in terms of questioning, if that's okay. In relation to the situation at a European level, obviously the pro note was one stage, which I suppose is now dealt with. We've heard in the media and we've heard comments from the Minister for Finance this week about the ongoing efforts to postpone the repayment of the €40 billion bailout loans that this country has received. I just wonder, could you bring us up to date on where that is at? And could you also specifically give us some level of detail on what the Minister referred to as options 1 to 5? I think the Minister said in media comments during the week that option 1 would be of very little benefit to the country, whereas option 5 would be of massive benefit to the Exchequer. So I'm just wondering if you could bring us up to speed with where that's at, and also just maybe give us an overview of the sort of difference we could be seeing in relation to debt sustainability, depending on whether we get option 1 or 5 or 3.
Okay. I guess the first thing to be mentioned and to put things in context is that the NTMA, I think, have explained that over the course of this year, what they need to do, and it puts everything in state, is they need to raise about 6 billion additional funding, market funding. And what that will do is that will allow us to have funded the operation of the state to the end of 2014. And we think that's perfectly achievable in the current markets. But that is a very important platform from which to build an exit program for the state after the end of the year, when we will have drawn all of the funding of the Troika program. What we then need to do is to work with them in terms of the remaining profile of the debt that we have, because obviously when we have a repayment obligation coming up, then we need to either go to the market or find an alternative way to source it. And the repayment of the debt from the perspective of the state on the Troika program begins to start to bite at that stage. And so the idea is that if we can find ways in which we can defer the repayment obligations of those debts into the future, then it allows us to have a lot less pressure in terms of the repayment obligations, and in effect the markets respond to that. The option 1 to 5 that you referred to is in effect a range of dates into the future in which we can actually do it. I think it has been sort of explained that some of the options would require or would involve pushing the debt out to a very forward date into the future, and others would involve just simply dealing with some of the what we call the peaks and troughs in the profile, so that we would flatten them out, and that would mean that on each of the years coming up over, say, the next 10 years, the amount that the NTMA would have to borrow from the markets would actually become a broadly level payment during the course of the years. Now, Jim is obviously much more closely involved in it in terms of the European meetings, but the ability to decide or to say what that will mean for the budgetary process going forward is frankly a little premature at this stage, because what's happening in Europe is they're trying to look at a solution which would alleviate the repayment schedule for the Irish debt and to do the same for the Portuguese debt at the same time. So it's not in possible for us to really give any indication of what actually will happen. More importantly, what's very difficult to do, and I guess we saw that in the context of the IBRC situation as well, is it is very hard to in fact find a way of calculating the benefit for the state in respect of those, because a number of different elements are at play. First of all, will the extension continue at the existing interest rates, but to the extent it requires reissuance of debt by the Europeans to allow us to continue the funding longer, then we'll be subject to market conditions at that time of the extension as to what the interest rate the Irish state would pay. The other thing that is very difficult is that the best way to describe the benefit of any of this, apart from the obvious market benefit of easing the repayment obligations, which is reflected in lower government bond rates, is that you look at what we would have paid and you compare it to the new interest rate. And as we saw in the context of the IBRC, had we done that 2 days before the IBRC announcements, we would have created a sense of a much greater benefit than if we did it 2 days later. Because what had happened was the mere announcement of the deferral brought the interest rates on the Irish government bonds down about 50 basis points. And so in some senses you could say there was less benefit in that transaction 3 days later, but it was actually the transaction that created the benefit itself. The maturities discussions that are ongoing at the moment are really doing the same thing. There is depending on the actual result of deferral, the amount of deferral, the interest rates, it could have an impact of different magnitude on the Irish government debt rates, and therefore would change our budgetary process just in and of itself. I don't know, Jim, do you want to?
Well, you've said an awful lot and explained the background, but there was a statement issued by ministers last Tuesday after they met in Brussels, and in that statement it moved the process on to say that the work that's been advanced should continue. The ministers agreed that we should consider the adjustment of maturities and the possibility of that, which is a positive move. It's not a decision just yet, and they'll come back to it for both Ireland and Portugal. They agreed then to ask the Troika to build on the work that's already begun at senior official level and to bring forward the best options for both countries. So there's still a good bit of work to be done, but as John was saying, the main point is to look at the peaks and troughs in terms of the maturity of the debt that's facing us in the years ahead. And it would be very helpful in terms of an exit strategy as part of a broader package of measures to ease that out, and that will give confidence to the private sector to invest as well. So the options are not fully worked out yet, but they range from a very short extension of maturities out to a much larger range of maturities. And obviously from our point of view, we would like to have a reasonably large extension of maturities so that there's confidence and there's a sustainable and durable exit from the programme underpinned by that.
No, thank you very much. I think that's very informative. On the issue of the banking division in your department, I think this was established last year. How many staff currently work in the banking division?
From the top of my head, it's about 25 or so. There are actually two divisions. I think that's important to understand. We have what I refer to as sort of a peacetime banking policy division, who will look at the sector as sort of a whole. And they analyse sort of the supply of credit, they analyse the broad positions, so they would in effect look at the banks equally, whether they are owned by the state or not, or supported by the state. And in that there's probably about 10 people, I suppose, in John's area.
Yeah.
If I exclude the credit unions from that. Then we have a unit which is staffed by people who were either recruited directly, who are civil servants who were already in the department and have actually joined sort of, that unit, and people that originally were part of the NTMA banking unit or banking division that was transferred to the department about a year and a half ago. And so they all work together in dealing with the government-supported banking situations and with NAMA. So that's where it is about.
And just, I think it'd be actually very interesting to have an insight into what exactly how does it work on a day-to-day basis? So what is, this is a key question that I think people want to actually know. What is the day-to-day interaction, I suppose, between the Department of Finance through your banking division with the actual banks covered by the state guarantee scheme? So if you could give us a bit of an insight into what those 10 people or thereabouts are actually kind of doing on a day-to-day basis in terms of interacting with the banks.
Okay. I think the first thing to remember is, and I think this is commonly misunderstood, is that there are different relationships between the department's SMU, which is the shareholder management unit, and the banks, and those of the regulator and the banks.
Yes.
Okay, so the regulator has a relationship as regulator of the banks and therefore has much greater access to information in respect of the underlying operations of the banks. Our role is effectively as shareholder in the banks. And the particular relationship with the banks is set out in a relationship framework, which we put in place at the beginning of last year. They were brought in place, I think, in March from memory. And they have set out, and they're publicly available on our website, they set out the negotiated, in effect, in terms of with the Troika, who had views on this as well, and our own views, and needless to say, the bank management. We set out a level of engagement, a level of involvement, you could say, in the operation of the banks. So in the case of remuneration and those, we have a different level of engagement than in, for example, individual lending decisions.
Yes.
And they are designed to insulate the banks, which should be commercial operations, from any sort of individual interference in respect of loans that we make. So this is why if we have situations where people want to know what's happening in a particular loan, and that's not a role that the department should play a part in. Our primary function is essentially therefore in respect of the appointment of, as a shareholder, in respect of the appointment of the board and the management of the banks should therefore run the banks. Now what happens is that we then have, and I trying to think when I think I laid this out at some stage, perhaps to the Finance Committee as well. We then have management meetings where we meet with the banks on a formalised basis on a monthly basis, where they lay out the performance that they...
And do you attend those meetings?
Either Anne or I will attend those meetings. And then after those meetings, we then have individual departmental challenge meetings where we look at the information that they've provided and in effect do a sort of a peer challenge in respect of whether we think they're performing well or not, and make suggestions. Now, in between times, of course, there are numerous meetings that take place at all levels with officials, both from the SMU and also those people that are in the banking policy section who are dealing with, for example, SME lending and mortgage arrears.
Okay.
Because they're dealing with them on a system basis, and they would have meetings with, for example, the management of AIB, as they would with Ulster Bank and others.
So at these monthly meetings, either yourself or Ms. Nolan is represented the Department of Finance at a most senior level. The CEO of the banks, they attend? The banks are represented by the
Generally, they would
CEOs?
attend, yeah.
And the chairmen of the boards?
No, what we are doing separately is, typically with the minister, we have then started to meet the boards and,
Okay.
in effect, the chairman or the CEO.
Okay, so the CEO, and do the public interest directors, where do they slot into this? We had the public interest directors in at the Finance Committee a number of weeks ago, or a number of the public interest directors. And to be frank, whilst I'm sure they're well-meaning individuals, it was very difficult to hear of it. In fact, I don't think they could provide one, a tangible kind of example of where their presence on the boards had made a difference. And I know I'd asked through a range of parliamentary questions as well, had the minister met with public interest directors? I believe the answer was no from memory. I think I'd asked, had yourself met with public interest directors? You might just explain to me, do you meet with the public interest directors?
Well, I think the first thing to mention is the position of public interest directors is somewhat sort of, difficult to define, because in many ways they are directors on a board and they therefore have the same obligations
Yes.
as directors of a board as other directors. So it's not as easy to distinguish them, although they are in that sense appointed. They were in effect, if you will recall, a creation of a situation before we owned all of certain banks. And so in some respects, subsequent to becoming the majority, or indeed the almost entirely 100% shareholder in AIB, we now in effect have the appointment power in respect of all of the directors of AIB. And so the distinction between public interest directors and the others is less relevant. In the case of Bank of Ireland, where we only have 15% of the shares, that's where the power to actually appoint public interest directors is itself more relevant. Because in that scenario, we could, as a 15% shareholder, find it at an AGM, irrespective of where we might think things should be on the appointment of directors, that we are outvoted by the other 85% of the shareholders.
But do you find, I mean, again, you're not responsible for policy, but there's no doubt if one looks back at the Dáil debates from the time of the establishment of the public interest directors through legislation, I mean, the concept here was you were going to have somebody on the boards representing the public interest, it's in the title, representing the taxpayer. It's very difficult to find, and I understand that once you join a board, you become part of the board. It's very difficult to actually find, though, tangible examples of how public interest directors are making a difference and are acting in the public interest in a way that any other director isn't acting in the public. You know, I mean, it's a suggestion that the suggestion was that they should be acting differently, or that they should be keeping that extra eye out for the public. And I remain to be convinced that that's happening, with no disrespect to the individuals concerned, because I'm not sure the structures allow it. So I'm just wondering, as Secretary General of the Department of Finance, what do you believe the role of the public interest directors is?
Yeah, I think all of the directors, okay, actually have under the Stabilisation Act a job to act in the public interest. Okay, so this is why I say it's quite difficult to see what this concept of public interest director and how it might differ from the others. All directors have an obligation, in effect, to act for the company and, in effect, to keep an eye on the shareholders' interests. And there is a conflict at times between what people might think is in the public interest and what is in the interest of the shareholder. Mm-hmm. Again, a sort of a further complexity, because people might say it is in the public's interest to have very cheap loans made available to them at very high interest rates, because I'm sure the people that are indeed sort of, benefiting that across the economy might think that that is actually a good advantage, but it is very much anathema to the interests of the shareholder, whose interest is to in fact see banks become profitable. I think what is fair to say is that in the last number of months, and in particular around the mortgage arrears situation, so during sort of from the summer of last year, as we became more aware from the discussions with the regulators of the lack of progress of the banks, we have had much more engagement with all of the directors, and we have asked sort of individual public interest directors to take sort of, a particular focus on, for example, lending to SMEs and mortgage arrears resolutions. But all directors of the banks we see as having a responsibility to solve those problems.
Yeah, and I mean, it's a view that I would share, that it's been very difficult to actually try to differentiate between the two, though the legislation at the time, though a lot has changed, it's clearly intended for that to happen. But what's your relationship in terms of communicating with public interest directors? And I mean specifically the public interest directors.
I haven't treated them any differently. I mean, at times I meet some of the non-executive directors on their own, at times we meet the entire board together, and sometimes not all the board is there.
No, just, when you said you'd asked some of them to focus on SME lending or mortgage arrears, that you've asked the boards of banks in general, as opposed to the distinct public interest directors.
The Minister has actually also asked the individual
public interest directors,
probably in respect of a specific reporting to him about the mortgage arrears situation and the SME lending.
Okay, so sorry, not.
Yeah.
Just the Minister met with all of the boards and said that he felt that they should take a more active role in looking at the mortgages and the SMEs, and specifically said that he considered that the public interest directors should do that. But they don't report directly to him. There isn't a legal line for him to look for reports directly to him on them. Their legal position is they are appointed by him, but it isn't a reporting relationship.
Okay, so the Minister would have met with all the directors of the boards?
He met with all the directors of the boards in the last 2 months.
And when was that? In the last 2 months? Okay, that's fine. Ms. Snowden, are you now the head of the banking division? Sorry, I'm
head of Financial Services Division, which includes both of the divisions, banking divisions that John described, and the EU Financial Services.
So did you succeed Mr. Torpy?
Mr. Torpy worked for me when he worked for the department.
Okay, sorry, no, just trying to understand the structure. And when did Mr. Torpy stop working as head of the banking unit?
He stopped working. He was last working in the department, I think, around the 14th of December.
Okay.
But he was on a month's leave in December, as it happened, and he handed his resignation in when he came back. And we asked him to move straight back to the NTMA, so he would not be in the department, to maximise the amount of time.
Okay. And I understand Mr. Torpy now works for Bank of Ireland.
He will be starting work, as I understand it, for Bank of Ireland around the 28th of March or the 1st of April, around that date.
Okay, no, I'm
not sure the exact date.
And we wish him well. I mean, this isn't about Mr. Torpy as an individual, but just this is a discussion that we've also had at the Finance Committee with the NTMA. What are the guidelines in place for people who are currently working within the banking division, particularly heading up a banking division, that then go on to work for the bank?